David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now, with this week's program from D.L. Blain Company in New Bern, here's David Blain.
Hello and welcome to All Things Money. My name is David Blain. Thank you for tuning in today, either on 94.1 FM, WNBU, or Cable TV 10 in New Bern. We're broadcast on both of them, so we appreciate you joining us today. We've got a great show lined up for you. We're going to talk a lot about portfolio construction and how an individual should go about designing their portfolio. We're going to step back from some of the details of what's going on and just kind of look at the strategic level for a change. Before we get into the show, let's give out our contact information. The phone number is 252-633-0107. Our email for the show is allthingsmoney@dlblain.com, and our website is www.dlblain.com. And we love to hear from our viewers and our listeners. If you have any comments or questions or topics you'd like to see addressed in the future, please feel free to contact us. So today's topic is what we call portfolio construction and the individual investor. And people come into my office all the time and they want to talk about investing. And I tell them that the easiest part of investing is picking the stocks and the bonds and the real estate and the actual investments to go in the portfolio. And they look at me kind of mystified that everybody thinks that's the hardest part. Well, it is very difficult to do, but the hardest part of managing a portfolio or a person's investments, helping them, is figuring out what exactly they want to do. The unique mix of investments that you put together to match that person's risk tolerance, their goals, their emotional component, such that when markets go up, they feel very pleased with their portfolio, as well as when markets go down, they feel very satisfied with their portfolio. And that is the most difficult part of investing, is matching the correct portfolio to the correct investor. What goes into the portfolio, there are all sorts of different strategies, active strategies, passive strategies, different types of investments, stocks, bonds, real estate. Once you figure out the mix that is going to keep that investor happy through good times and bad, the actual investments, you can certainly add value. We think we add value by the types of investments that we use, but in the larger scheme of things, the most important decision that you make is based on the individual needs of the investor. And we use a 4-part model to determine this. There are certain return requirements that an investor needs. There are certain risk constraints that an investor has. And this process, when you use, and I'm going to use the example of us where you have an advisor. I realize a lot of you listening do it yourself, so you will be both sides of this equation. But when working with us, we have a portion of the return side of things that we determine, and the client has a portion. We have a portion of the risk side of the equation that we determine, and the investor has a portion of that. So let's start with the risk side of the equation. We have for each portfolio what we call a risk objective. And for the client, this is determined by what we call the risk tolerance, their willingness to assume risk. Now, this is not an exact science by any means. Trying to figure out someone's risk tolerance is extremely difficult. And we certainly use a survey that we think is very good at doing it, where people answer questions and we are able to rank them on a scale of more risk tolerant to less risk tolerant. Some surveys are better than others. We happen to use one that's comes out of the field of psychology. We think it's pretty decent. But make no mistake, assessing someone's risk tolerances is very difficult to do, and some of the studies tend to indicate that people's risk tolerance does in fact stay fairly stable over time, but when markets are crashing or soaring, people do tend to change their outlook on risk it's not their risk tolerance is changing, it's their perception of risk. When the markets are going up, the perception of risk in the stock market becomes lower. When markets are crashing, people's perception of risk of the stock market changes to they think it's now riskier. Well, the reality is the risk of the market is the same at all times. It's the person's perception of risk. And their tolerance for risk is generally thought to stay the same. It's just that external events affect that perception of risk. So that's one of the hardest things to figure out is the client's risk tolerance, because that's what determines the different type of mix that you have. Now the advisor, or if you're doing it yourself, your case, the other side of the equation is your ability to assume risk, what we call your risk capacity. So you have your tolerance to assume risk, and then you have your capacity to assume risk. And your capacity to assume risk is more objectively factored. Do you have a stable income and job? Do you have people that rely on you for income? For example, if you're single, you have a much higher ability to assume risk. If you're married and your wife doesn't work and you have several children getting ready to go to college or something, your ability to assume risk is much lower. Do you have other sources of income outside of your portfolio? Let's say you come from a very wealthy family and you're going to inherit a large sum of money at some point. Well, your capacity to assume risk is much higher. So we assess this. Your willingness is more subjective. Your capacity to assume risk is very objective. And so those two things together form what we call your risk objective. On the return side of the equation, which is what most people want to focus on, each individual has some sort of desire for their return, what we would call their return expectations. What do you expect to earn? A lot of times we find that people's return expectation is very unrealistic, that they think they can earn 12 to 15% per year from an investment portfolio. Well, that may happen over a few years at a time, but over long periods of time, more than likely that is not going to happen investing passively in something at all. And so we have to work with someone to determine what their return expectations are and make sure that those return expectations are viable in the capital markets. We also look at those expectations against their willingness to take risk as well as their ability to take risk. Well, we're coming up on a break here, so I'm going to stop there. We have one more section to go, and that's the return requirements that you have. How much return do you need to make from your portfolio? Then we'll go back and we'll recap this portfolio construction process. But for now, we're going to take a short break. So for All Things Money, I'm David Blain, and we'll be back in a few minutes.